Hi, Chris.
Hey Dale, thank you. Yes, can you hear me?
I can. Great to meet you, Chris. I saw you on Twitter. What really attracted me to you, you seem different than most gold advisors who live the mantra, don't wait to buy gold and wait. And when gold broke down, you showed it, and you talk about both sides of the market. So kudos to you. Before we get into the markets, Chris, I'd like to know how did you get into the business as an advisor in markets, and why did you gravitate towards the precious metal industry?
Yeah, thanks Dale so much. So my background is a little bit different than most who you will find in the industry. I actually started my career as a civilian, quote unquote, a civilian working for the Department of Defense. And I was involved in mapping and reconnaissance and creating maps specifically for the military. I spent a year in Iraq and Afghanistan, and wow. We were if you can imagine, so the job there is there's a lot of diverse information, a lot of complex information, and the job is really to create maps that boil things down in as clear terms as possible to get the necessary information in front of the decision makers. In the mid-2000s, I also started to see with my own eyes that the direction of the wars was not exactly what I anticipated going in there, and I began to study sound money and study some of the problems with fiat currency and how that was actually contributing to the war that I was there in. And I decided upon returning home that I wanted to do something and align myself with a cause that I believed in more long term. And the precious metals is one of those.
What a great story. Could I assume that you came to the conclusion that at times our country will get into wars to protect the hegemony of the US dollar? And part of the reason that we may have gone into Iraq is Saddam no longer wanted to accept the dollars for oil payments and wanted other forms of payment?
Yes, I'm certainly open to ideas like that. And of course, it's a multifaceted type of situation. And I call them the wars because there's several wars going on and we're still there for all practical purposes. So there's certainly multiple causes going on. One of the themes that I gravitated toward was simply the amount of waste that I was seeing. Endless tankers, tanker after tanker of gasoline, oil, food being flown in from around the world, and then let alone the waste of tax dollars and of human life. So it's just something that I gravitated toward, especially in the later part of my years. But just to bring it back toward the precious metals, there's this link between the precious metals and war, in that in times of high inflationary war, war being one of the most inflationary things that there is, the precious metals tend to respond. We see that going back. I don't know if you can see can you see my screen here fairly clearly?
Yeah, we've got it, both. Yeah.
So
you're showing a very long-term chart, 74, gold 1974 to 78.
Exactly. And we look at, think about this time period, the period following 10, 12 years of unsustainable conflict in the Vietnam War, and all that pressure builds up on the currency. And of course, that's when Nixon was forced to sever the link between gold and the dollar in 1971. And we can see what happens with these recovery attempts, let's call them attempts, from 74 through 78, the 50% decline and 100% recovery. And then when we zoom that out, keeping that y-axis on a linear scale, you can barely see the decline in the recovery when that pressure is built up there in the market. But I'm jumping ahead. It's just to say that I saw with my own eyes some of the need for precious metals, but I also see something else which I did not appreciate in this industry going back into 2008, especially the crash of 2008. which is that so many within this industry who saw the problems with fiat currency and with the banking system, they completely failed to recognize that precious metals, especially silver, and especially we want to look at the mining sector, that they could fall so severely in a short-term deflationary period as we saw there. And so I really gravitated toward technical analysis as just a way to, in a way, filter out some of the rhetoric, and let's see what's actually really happening on the charts themselves.
Okay, yeah. So, you're showing this period that was the prior bull market. We peaked on speaking about wars and history rhyming. The peak was when Russia invaded Afghanistan, and I believe the high was about 880, which marked like a 20-year top. So people went through a lot of pain after that peak in 1980. That was a Hunt's attempt to corner the silver market, and silver went to 50, and then we went through the Bataan death march all the way to the year 2000. So
That's
interesting.
exactly right.
Yeah. So, I'm a little bit of a student of history too. And, a lot of people don't even, remember that bull market. What's interesting about that bull market, and, you have a lot of people that are bearish. I know you're going to show current time periods is normally a very important high like that was in 1980 at times can be retested. So, there are a lot of people calling for under 1,000 gold. 880 might be a potential target for this bear market to end later in the year. But go ahead, let's just continue with your PowerPoint here. You're going to go to another time frame here.
Yeah, I agree with those statements that you made. Let me just show the backdrop of, so this was the bull market as you were just talking about, leading into that high. I think we're showing, some closing prices here. So the exact numbers will be slightly different. And so, but when we look at, so this leads through 1980, price came all the way back down in 80, 81, and then we can see falling all the way back down below 300 here in 1985. And this chart now shows that same recovery pattern, that attempt at a recovery that we saw from the 80s through 1987. And if you think about what was happening here in the rest of the world, the fall of 87, we had the crash in the U.S. stock market. Basically, the crash in the U.S. stock market, the crash of 87, corresponding almost exactly to the top of the recovery attempt here in gold. So gold climbed its way back toward 500. And think about this in percentage terms. This is a greater percentage move than we saw in 2016. We saw about a 30% move there from 1045 up through 1370. This was a lesser, so this was a greater percentage move. But then I wanted to show the ramifications. What we can see here is that
wasn't that during that time period, the dollar was getting smashed, interest rates were heading up, which eventually led to the panic in stocks. And after the panic, okay, go ahead, buddy.
Yep. And so then, we can see that when there's a market that's forming this, this is basically, if we were to take the right hand of this pattern here, this is something of an ascending recovery attempt forming this triangle-shaped pattern. But you can see what happens, and I think sometimes the most simple forms of technical analysis are the most powerful. And we could see what happens when there is a failure of the market to hold a structure, a structure to the recovery. Let's zoom this out a couple more years. There's that same pattern. Look, there was the failure of the recovery attempt, 12 more years of declining prices. And I should say, it's not that the price collapsed, from this failure of the recovery, let's call it 440. Okay, the gold market made a low around 250. In percentage terms, from that 1980 high, a significant portion of the damage was already done by this point, but it's more a question of time. It's a question of, hey, the market actually took almost 15 years to get back to that point after that. So
Yeah,
let's just
so
bring it
that
into
was
the present.
some type of
Yeah.
opportunity cost if you were tied up in gold, maybe underwater when there were other things going. It almost took a generation, and the low was in, I believe, 2000, around 200. Isn't that correct? I mean, everything that.
Correct. Yeah.
Yeah, before 9/11, we had bottomed. I remember there was some type of change in central bank policy that generated the first wave off that 200 low. I don't remember
Yeah,
what it
that's
was.
exactly right.
Do you,
I
young
think they
man?
called that the Washington Accord.
Okay. Yeah, all right. Beautiful. Yeah,
And that
so
was where the central banks, basically it was just a statement that they made, counting for this wave. Excuse me, no, it would have been the next wave, I believe.
right.
But where they said, yes, we're going to continue to keep gold on our books as a reserve asset. Basically, just a
Okay.
statement.
Yeah. Okay. Because back in 2000, people were saying, "Oh, it's an archaic relic. Yes, it makes a good paperweight. Don't drop it on your foot." And
Exactly.
that was the bottom. So you're showing a similar breakdown on your next slide that we had from this
Right.
one.
So we've got to be careful here and think about what was happening, by the way, the entire time here in the late 80s through the 90s. Think about the macro backdrop. Now, the dollar was falling, especially from the late 80s through the mid 90s. So this is a point that I want to make because I'm actually bearish on the dollar at this point as well. But those two things are not mutually exclusive. You can have, and there are periods of many years where we see this in the markets, you can have a falling dollar and a falling gold price simultaneously. So that
Yeah.
was seen, here throughout the 90s. What else did we have happening here was the mania developing in the broad stock market,
Yeah,
especially.
the bottom in equities was August 1982.
Exactly. Yep.
At
And
7/6.
so, this whole time we were starting to get that acceleration in the stock market, which is similar to what we're seeing today. It is, and there is inflation happening the entire time. Inflation is theft. It is the stealing of the purchasing power from mostly from the middle class who has some discretionary savings, and that purchasing power is being given to institutions, the controlling institutions who are connected with the Fed. I do know these things. Most people in the precious metals community are aware of these things, but that doesn't stop just because there is inflation going on the whole time. That doesn't mean that gold has to rise every single year. So I just think we need to be careful about always having sort of set assumptions.
Okay. Agree.
So let's look at the
You
present.
you brought up that you could have a falling dollar and falling gold prices. You could also have a strong dollar and rising gold prices, can't you, Chris?
Absolutely. Yep.
Yeah, and that would fool more people, I think, than a weak. They're both kind of counterintuitive, but a strong dollar, I think, would really have people thinking, well, how could gold go up? Do you know what
I think that
period
very
that
well
happened?
could happen.
Okay, so but you're bearish the dollar here.
I am bearish the dollar here, and I will pull up. Let me pull up my dollar chart here for a moment. I've got it on another
Okay.
platform here.
Okay.
And I'm mostly bearish on the dollar based on looking at some of its constituents here. Let me pull up the euro USD long-term view. So what I like to do is start as long-term macro as possible. And here we are looking, just to give you my backdrop of where the dollar and the euro are. So here we're looking at the euro to the US dollar, and we're looking basically post freely traded era, all the way back to when the euro, we're talking about the constituents of the euro, mainly the German Deutschmark.
Right.
And what we're seeing here, of course, bringing it into the present at 115, what we can see is there are these clear 8-year cycles that tend to form. So from 85 through 1990, 1992, 1993, this up cycle, then an 8-year down cycle into 99, 2000, 2001, an 8-year rising cycle into 2009, and then an 8-year declining cycle here into 2015. So my analysis, and we can see what's happening here, this convergence. Look at this extremely long-term rising support line. It's no,
what
look at that right there.
Huh? Isn't that amazing?
Incredible. Yep.
Yeah.
Yep. And I was
okay. So could the euro? So the euro uptrend really is okay unless we take out 105. So we could go 110, 107 and a half, and then begin to return back to the upside, and that would not disturb the uptrend. Okay.
Yep. And there's still about 3 years here left in this convergence. If we zoom this in on the last portion here, we can see this could really extend out into 2020 a bit. These triangular shaped consolidations tend to resolve before the apex, so we should be seeing a resolution here. We're going to know, is this a dollar bull market or a dollar bear market? We'll know this within the next 18 months or so.
Okay. All right. So why don't we get back to the present situation? And that was the chart I saw, and I said, I got to have this guy on F.A.C.E because he writes a gold letter, and he's showing a breakdown, and he's warning people to, hedge or be careful about being long. So this is kind of a market analog to the one you showed, I think, from the early 80s. Do you think it's going to take 12 years like the previous example?
Now, I certainly hope not, because, for my interest, and I am invested in the precious metals, and I do run a business helping people with the precious metals, but some of that is tempering the outlandish enthusiasm that I do see sometimes in this sector. So yeah, just going back one more time, just so people can see, here's that 83 to 88. Look at the shape of the recovery. There's the failure. We see the result right there, and then let's look at where we are right now, this 2013 through present attempt. Now, is this going to take the same amount of time?
We could rally back to the breakdown before we head back down again. I only bring that up, not because it's, my view, although I think we could have, I'd like to see the big round number taken out at 1200, but there is extreme positioning in the COT report, Commitment of Traders report. Do you follow that?
I do follow it, but I'll tell you what, I have never seen anyone consistently trade based off the COT alone.
Okay. Yeah, not alone. Yeah.
Yep. And I will say this too. I've also seen periods of time. There's a sense where the speculators
are always wrong.
There's this idea that the speculators have to be wrong, right? Always. Yeah. They can be right for many years in a row.
Yeah, and commercials could be wrong because they have deeper pockets than speculators.
Absolutely correct. Yep. So these people can be right for quite a while. So I always default to price. Price has certain patterns. What do we care ultimately about? It's price. I look at a lot of sort of secondary indicators. RSI, a momentum indicator. I look at some relative strength. Gold versus the various commodities. What's happening? But truly, what do we care about? It's price. And when we see a breakdown like this, I think we could have a rally coming up back to the breakdown point, sometimes even higher on a sloped trend line like this.
Yeah.
And we will know, every once in a while, a model can give us a false breakdown. Every system of analysis in the world has false signals that show up. So could this still manifest? Could gold recover this broken trend line and resume, a rounding out of the bottom and then an eventual bull market? It could, but look, it just has to show us. It's not some crazy figure here. We just need to see gold come back above 1260 or so and certainly stabilize in that 1300 region. And then I'd be willing to look and say, wow, it just gave us a royal fake out, so to speak. But until we see that, we should place the bias from this pattern in that the bottoming attempt is going to take a much more circumventous route than we hoped for originally.
Okay. All right. Do you have any views on the gold-silver ratio, which was starting to come in a bit a couple of months ago? And what is your view on silver? Similar to gold, more negative or more positive?
Yeah, I do have a view on the gold to silver ratio. It's something I follow quite closely. Let me pull up the chart here. And there's a bit more going on here. It'll be it's a few things that you will notice on this chart. But the big picture of it here is you can see in black this multi-decade resistance zone. Let's call it between 80 and 84. Let's round it off here. So 1, 2, 3, 4 major attempts here on this resistance zone. And then you can see when these trend lines have broken, these rising multi-year trend lines, it tends to result in significant and quick moves lower in favor of silver in the ratio. So we're back within one of these, these rising trends here. And there is a school of analysis that has said, and I've seen this posted a lot, that, hey, we're back in this zone. This zone has represented fairly important lows. When the gold to silver ratio is at a peak, it tends to represent lows in the sector because we're essentially seeing the speculative bid completely absent of the silver market when we're in these highs here. But I would just caution people again, don't take anything 100% for granted. The window, we'll zoom this in. The window here for this ratio to start breaking lower is in front of us. It's over the next 12 months or so.
Yeah.
Yep.
Back under that.
So we would want to see that.
Yeah.
Correct. Coming back down, let's call it 76 or so. If we see that move, and certainly below this swing low at 75, if we start to see that here over the next 12 months or so, I think the sector has a very strong chance of recovering and perhaps negating that breakdown that we were looking at. But I would say if we're watching this and we continue to see this ratio, especially if it starts to exceed this 83, 84 level, I would just say, wow, that we're being shown something by the market which could be quite contrary to what a lot of people are expecting. In that silver, it would basically be telling us this: if we see this ratio remain here, it's telling us that the market as a sum is very comfortable with silver as a primary industrial metal for the foreseeable future. I do believe there will be a point that silver is re-recognized as a precious metal, but that could be some time off into the future.
Okay, so I see you also cover the miners, and they've been decimated. They were underperforming gold when gold was at 1360. Most of the miners were not even close to recent highs. They've been punished. What are you seeing there in the miners? And do you subscribe to what I was taught, that it's always more constructive when the miners are outperforming bullion than the other way around?
In general, I do believe that, except for it's actually ironic when we look at important turning points in the markets. The miners often get it wrong. They literally just get it wrong based on excessive enthusiasm in the sector. So what I usually do is I just compare, the miners on top to the price of gold or the GLD fund on the bottom. And let me just show you that example. So I look at it over various time frames. We continue to look at various time frames. Look at right here. For example, we're looking at the GDX on the top, and I have not updated all these charts here, but look at the GDX. Look at this little mini breakdown right at the beginning part of 2016, where it basically made a false, look at where we are here, January, a false little flush down below the previous lows here. this did not correspond with a new low in the price of gold. If you look where we were, the price of gold here in February 2016, it was already rounding up, and the miners made this final little flush.
Higher low in bullion, lower low in GDX. Great example.
Exactly. And so this, basically we have these false moves where sentiment in the sector just gets so lopsided that boom, then you have a 200% reversal, and basically anyone who sold into this signal just never had a chance, to get back into this sector. Of course, then what you said earlier, Dale, about the underperformance here, we can clearly see, look, gold getting back up to the highs, miners nowhere near, they're rounding over right now.
That's what kept me bearish gold. Yeah, that's what kept me bearish gold when we were 1360, was the underperformance of the miners. But what are you seeing here now, Chris?
Yeah, so when we look at this, we're still within this consolidation. I mean, we're fractionally under it right now. What's the print here for today? Opening at 2068 on the GDX. We were looking at a consolidation just below 21 through 25 and a half here. Let me change it over to this perspective, a little easier to see. Support and resistance. Okay. It looks like we're flirting with that level. It looks like the miners are getting ready to break down. So we could have a breakdown. Look, but here's the other point about the miners. The miners had come, when we look at the, all the way going back to 2011, the miners had fallen by 80%. That's 80%, over the course of 4.5 years. When a sector that cannot go to zero has fallen by 80%, there is something very interesting, from a value perspective.
Yeah. Buy when the blood is on the street. Yeah,
it is. Yes, exactly.
I remember that. No one liked him down there.
Oh, I know, and there were all sorts of signals that there was at least a
like Mux went from like 70 cents to $5. I mean, there were 4 bangers on a lot of shares, 4 or 5 bangers on that rally. That's why people love to trade them. They're rainmakers at time. They can refresh your financial landscape with a nice rain shower. So what a great interview, Chris. Really, anything you wanted to wrap it with, and also perhaps you want to show your website. I know that you have a newsletter, and that's your business model, correct?
Yeah, that would be great. Last chart that I do want to show really quick, and then I'll pull up the site, is this one. Just talking about the miners once again. This is one that'll really blow people away. We're looking at not the GDX right now. This is the XAU mining index, and the reason I'm looking at this one is because it goes back further in time. It goes back all the way to 1984. And when we look at the XAU relative to the S&P 500, which is the broader, let's call it so we're talking about the gold miners relative to the rest of the U.S. economy, and the largest part of the U.S. economy. The levels that are, including that 2016 rally, which was just right down here.
Yeah, it looks like a minor blip. Yeah.
Exactly. And when this only goes back to 84, but I have brought up some of the constituent components of the XAU, that go back, some of the Barrick and Newmont predecessors. This ratio actually, this ratio actually reached 1-to-1, and right now the ratio is at 0.02. So yes, over the short run, there's some bearish signs here that are coming in the sector. But when you have something like this cannot go to zero. A ratio between 2 segments of the U.S. economy cannot go to zero, and this is the lowest this has ever been. I would just tell you, so this is why I launched the business, looking at ratios such as this, and that is what I focus on. And so our point right now with the website is, look, very few people were prepared for the rally in 2016. We are getting prepared now. So it's like, let's get prepared. Let's watch these things as they unfold. and we will get ready for that next rally when it arises. So we do cover, there's flash alerts
Everything.
that go out. We do cover,
Yeah.
yep, everything. We do private placements as well, which are a more targeted form of analysis, of investments in the small junior sector. But yeah, they can check it out if they want, iGold Advisor. And just know that I take no funds from any of the companies or anything that I profile. I'm entirely subscriber supported, and that's the way that
Yes, you're not an investor relations guy, pumping stocks because
Correct.
you've got restricted or free trading.
It's just not my model.
Yeah.
Yeah.
Well, I love your model, and I think you're my go-to guy for gold analysis from now on, Chris. If you agree to it, you're my gold analyst that I'm going to go to as I see things unfold. Well, I encourage everyone to go check out Chris at www.igoldatvisor.com, and that's also his Twitter handle to follow him. And really appreciate you coming in. I'm glad that we were finally able to break the ice, and you taught me some things today. Great macro historical perspective that you have. So I appreciate.
Thank you so much, Dale.
I appreciate your time today, Chris. We all do.
It's great speaking with someone else who remembers some of these cycles and who's looked at them as well, because I really do think it's important to look at the lessons from history, as you said.
Okay. All right. Well, Chris, good hunting, and I appreciate your knowledge. How old are you? Let me ask you that. Do you mind answering?
38.
Okay, so you've got a lifetime ahead of many more cycles, and you have a great background in what you specialize in. So again,
thank you, sir.
Great presentation, Chris. Have a great day. And that's it for us today. Thank you, investing.com, for viewing this. Chris, you got on investing.com today. And remember, most of all, whatever's happening in the markets, don't just count your pips, count your blessings. Chris's Twitter handle is @iGoldAdvisor. Michael. All right, everyone. See everyone for wrap up on TGIF, and enjoy the rest of your day. Thanks again, Chris.